What's up everyone? In this video we're going to see how to create the perfect investing portfolio based on your age. So no matter if you are in your 50s and you want to retire by 65 or you are in your 20s, this video will show you exactly how to tailor your portfolio to achieve your goal in your desired time frame. To do this, I'll consider all important factors like inflation, your yearly expenses, your desired goal, and I'll tell you exactly in which ETFs to invest, how much you need of each ETF based on your age, your risk tolerance and goals, and the return you would have if you had built this portfolio 10 years ago. In the end of this video, I'm going to give you access to a tool that I created for you. That is an evolution of my old ETF Portfolio Builder that my subscribers already know. You're going to have 3 tabs. One for US investors, one for European investors, and one for Canadian investors. My name is Rick. If you're new to this channel, take a moment to subscribe to it because you'll find a lot of free tools for your investing journey. And now let's go right to the first step, which is defining the financial goal. There are basically 2 ways to define your financial goals, and you can't skip this step because the portfolio you'll build depends on this. The 2 methods are either you have a value that you'd like to achieve, for example, you want to achieve $1 million no matter what, or you can calculate the value needed based on your current annual expenses. The second method makes more sense because it's based on the idea that if you reach the calculated portfolio value, you can live off it forever without needing any additional income, and you're going to be able to withdraw from it every year everything you need for your expenses without ever running out of money and considering all factors like inflation. Find a way to get a value that represents your current yearly expenses. With that information, in our tool, we can start inserting our current age, let's say 30, our retirement age, let's say 65, and then you have your current yearly expense, let's say $40,000 per year. The tool is going to automatically calculate that if you spend $40,000 now, when you retire at the age of 65, you're going to spend an average of $112,000 per year. This is because of the increase in prices due to inflation. And I use an average long-term inflation value of 3% per year. Feel free to change it, but 3% is a good estimate. The tool calculates the value my portfolio must achieve before my retirement so that I can withdraw my yearly expenses, namely $112,000 every year from it without ever running out of money. This value, which is $2.8 million in this particular case, is calculated based on the FIRE method, which is based on the 4% rule. It means that if you achieve $2.8 million, you can withdraw 4% of it every year, which is this $112,000, and the portfolio is going to grow on average more than this 4% so that you have a probability close to 100% that you will never run out of money. $2.8 million in 35 years because of inflation is going to be worth like having $1 million today. So real portfolio in the future is this, but the value is going to be like having this value today. Now I can report this value, the inflation adjusted portfolio value, in my goal here, $1 million. If I don't care for my yearly expenses and I just want to get $10 million by the age of retirement, I can skip these yearly expenses and write $10 million here. Now, many viewers ask me how they should invest based on their age, and obviously this is not a question that can be answered in the same way for everybody. It depends on so many factors like your current financial situation, your income, if you have a family, if you have money saved, when do you want to retire, how do you want to retire, and so many different things that I could only clarify with you in a one-to-one consultation. By the way, if you're indeed interested in a one-to-one consultation with me, you'll find a link in the description below that is totally non-binding, totally free, and it's just for you to get a huge discount that you can use in the future if you want a personal one-to-one consultation with me. In this video though, I'm going to talk to thousands of people and you all have a different situation. But there are still 4 general measures that you need to apply to your portfolio to ensure that it's well suited to your particular situation. First of all, it needs to be diversified, geographically and in terms of sectors. This is going to be important at any age, but it's going to be more and more important the older you get. Second, the expenses of your portfolio, or the expense ratio of your ETFs. An expense ratio of 0.5% might not seem like a lot today, but this value is taken every year from your total value, so it's more and more over time. My rule of thumb is I never invest in ETFs with an expense ratio higher than 0.3%, but most good ETFs are going to have a much lower expense ratio than that, so you're not going to have a problem. A third factor of a good portfolio is the growth potential, and this is going to depend strongly on your age. The younger you are, the more your portfolio should be growth-oriented. Growth companies reinvest most of their earnings pre-tax every year, achieving in general a stronger growth than other companies, which means your portfolio is also going to grow faster. But the closer to retirement you are, the more you need to give up this faster growth for higher stability. And how do you do this? There are 2 ways. The first is to start investing more and more into the value sector, and we're going to see later how to achieve this and which ETFs are well suited. And the second is investing in bonds. Now, I have to say, bonds are not so popular right now because of the terrible return they had compared to equities. Here in this table, you see which return your portfolio would have had every year from 1997 to 2022, depending on how much of it is bonds and how much equities. 80-20 means that you have 80% in the total stock market and 20% in bonds. All the way to 20-80, that means that you have 20% in the total stock market and 80% in bonds. The same is also represented in this table. The blue line is 80% equities and 20% bonds. And you can see that the line fluctuates more, going from minus 30% to plus 30%. The green line instead is 20-80 with overweight in bond. And you see that not only it fluctuates less, but the most important factor is that it almost never goes under zero. So the fact that it rarely gives negative performance is the reason why in retirement you're going to have a safer portfolio if you have bonds. Because in retirement, it's not about growing your portfolio, it's about preserving it. Alright, let's go back to our ETF Portfolio Builder. We've written our goal, in this case $1 million, and here we still need to write the initial capital that we have. Let's say you have zero right now. The tool tells us that if we want to achieve our portfolio goal in the time we have available, we need to invest $741 every month. Now here it gets interesting. The value you get here based on your personal assumptions is the value you have to confront yourself with. If it's too high, you need to either invest for more years and retire later or reduce your expectations. If it's lower than what you can afford to invest, well, my friend, invest as much as you can and you'll be able to retire earlier or wealthier. In any case, this value is going to be an important reality check for you because it considers inflation, it considers your expenses and your goal, as well as the time you have available from your current age to the age of retirement. Let's get now to these last inputs. With the tool, you have the freedom to decide yourself what to select. This is not because I don't want to do the dirty work for you, but because I'd rather give you the tools to be able to make a responsible decision, because again, every person has a different situation. First point is if you want to give up bonds. If you write yes, the generated portfolio won't have any bonds. If you write no, the tool suggests you an amount of bonds which is equal to your age minus 10, but only if you are 45 years of age or older. So for example, if I write here 45, the tool suggests 35% in BND, which is the Vanguard Total Bond Market Index Fund ETF, and the rest in VO, the Vanguard S&P 500 ETF. After bonds, the second important decision you need to make is if you want international diversification. I'm going to be brief here. I believe that international diversification is always important, but it becomes even more important if you're older. So for my viewers over 50, I surely suggest diversifying worldwide, above all considering how the US, even though it's still the biggest economic and financial power in the world, is slowly getting close to rising countries like China. So let's choose yes here. And you see that the portfolio gives you now 13% on VXUS, which is the Vanguard Total International Stock ETF. It gives you a global coverage with developed and emerging markets, excluding the US. If you invest from Europe, let me just switch to the European tab, and you notice that the core position with the Vanguard S&P 500 ETF and the international position have been substituted by just one ETF, that is EUNL, the iShares Core MSCI World UCITS ETF. This is the biggest world ETF in Europe per assets under management, and since it includes both US and international, you don't need to have two separate ETFs. Then we have the choice between growth or dividend oriented. And here my suggestion is to be growth oriented if you're younger than 40, balanced if you are between 40 and 50 years old, and value oriented if you're older than 50. The final choice is up to you, of course. But remember what I told you at the beginning. Growth stocks have more potential, but also more risk and volatility. So they're well suited if you still have many years in front of you and big crashes are not going to be a problem for you. Value stocks might grow less over the long term, but they're safer and more stable. The last choice is your investing experience. And here, if you have less than 1 year of experience, regardless of your age, I always suggest having a really simple portfolio. You're going to have VO for core position, VXUS for international diversification, and if you want, BND for bonds. Obviously, assuming that you want bonds and international diversification. If you remove one of them, the portfolio automatically adapts to your choices. And as you can see now, it gives me 80% VO and 20% VXUS. I want you to notice that here the table gives you the details of the portfolio with ticker, name, possible alternatives, current ETF price, and the amount you should invest every month depending on how much you're going to invest in total every month. For example, in this particular case, I wrote 45 years of age, 65 years at retirement, so with 20 years available and a goal of $1 million inflation adjusted, the tool tells me that I need to invest roughly $2,400 a month, which are distributed here on the ETFs. So the more you're experienced with investing, the more you can choose here, and it's going to result in a more complex ETF portfolio. Remember though, that more complex doesn't mean better, just as simpler doesn't mean worse. You can have a great long-term return by simply investing in one single, broad-based ETF like VO, and whatever other ETFs you add is not necessarily going to help you. I need you to keep this in mind. Okay, guys? Nevertheless, if you're interested in which ETFs you can invest in, if you are more experienced, you can just play with the cell here. And for example, with 2 to 5 years of experience, it gives you QQQ as growth ETF and VIG as value ETF, both with 23.4% respectively. Alternatives to these ETFs are QQQM for growth, which is like QQQ but with a lower expense ratio, SCHG, VGT, and FTAC. Alternatives for value are SCHD and VYM. Now, I want to quickly show you two really interesting functions of this tool. The first is this table here that compares the performance of the last 10 years of the total stock market with the performance of the portfolio that you set up answering the question. So for example, in the current configuration, our complex portfolio that you see here would have returned a total of 229.35% in the last 10 years, which is equal to 12.66% per year. This is a little bit better than what you'd have achieved by just investing in the S&P 500. That would have given you a 223.58% return, equal to 12.46% per year. Another thing I want to show to you is the rebalance tool down here. You just need to write your current dollar value in the single ETFs, and the tool tells you what you need to sell or buy in order to get to the exact percentages that the tool suggested above. Since we are in a pretty unstable moment of the stock market now, considering everything that is happening with tariffs and further conflicts between the US and the world, you need to have all the tools to navigate these unstable markets. And I suggest you do this by jumping to this video of mine where I explain how you can actually profit from this market instability and get rich out of 2025. So just click here and jump into the next video. And after that, remember to subscribe to the channel for more videos like this. I'll see you in the next video. Ciao!